You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back to Mining Stock Education. I'm your host, Bill Powers. Joining me today is my friend Jamie Keech of ResourceInsider.com. He has a service where he finds and puts together deals for accredited investors to invest in private companies as well as publicly traded companies that are doing financing. And Jamie, welcome back onto the show. Let's talk how you performed in 2021. A lot of the investors listening to us out there, it was a tougher year. I had some 3 and 5 baggers myself, even a 10 bagger at one point, although it wasn't realized. But I also had a number of 50 to 60% losses. And sometimes if I reference that, people hear and say, what is this guy doing? 50 to 60% losses. Well, my 3 to 5 baggers offset those. So I was net positive on the year. But what are some of your thoughts about last year and its challenges?
So last year was actually a really good year for us, and I can get into why that is. I actually think probably some of the best deals, I was going to say the best deals, but we did a couple of really good ones the first year. But I would say many of the top 10 deals we've ever done were done in the last 12 months. So we did, I think it was 8 deals last year at Resource Insider, and we invested in a range of commodities from precious metals, from lithium, to copper, lots of different things. And what we did last year is we did almost the exact same thing we did when we launched Resource Insider, which was in 2018. So in 2018, as you will recall, Bill, no one gave a shit about mining. No mining companies could finance. It was, we were just starting to peek our head out of the worst of the bear market. And when Resource Insider, our service came on the scene, there were very few financing options for exploration companies. And we were able to go out and we cut really, really good deals on, I think we did 5 or 6 deals our first year. And of those 5 or 6 deals, all of them except one were private deals. And we had to wait patiently for about 12 to 18 months. And even after our first year, our portfolio was down because the one gold deal we did was actually down the first year. So it wasn't, it was not looking very good on paper, but I was very, very confident in the underlying fundamentals of the companies that we invested in. And, skip ahead from sort of when we were doing this, which was late 2018, early 2019, to obviously March 2020, when things really started taking off. This is where we made a lot of the biggest returns that we've ever made at Resource Insider. This is where we had, 2, 3, 5, 10 baggers, all that sort of thing. But we had to be patient to get them. So skipping ahead to last year, 2021, we saw a little bit of this again. The shine had obviously come off gold and precious metals by, mid 2021. And people at the beginning of the year, I don't think could really quite start to appreciate what was happening in copper. So we did, I believe it was off the top of my head, 9 deals last year. Of those 9 deals, 4 or 5 of them are still private. And of the ones that are public, we've got winners and we've got losers. But I think we've positioned ourselves as a portfolio to see really, really strong returns over the coming years. So I think our total 2021 returns were about 7%. However, again, all those private deals are counted as 0% returns because they're not listed or trading or the price is not moving. We've had 1 or 2 that are down by, I think 30, or one is down 16%, one is down 60%. And I think that's a deal you and I share in our portfolio, silver deal.
Thanks for reminding me.
But we've also got some that are up, 500, 600, 700% as well. So they do tend to balance out. But I think what I consider when I'm investing my own money, what I know Resource Insider members consider, and we've talked about a lot with our members, is these investment opportunities. They're not designed to build returns on a 4-month or 6-month time frame. We're typically taking 18 to 24-month views on these companies because you're providing these companies with the seed capital, with the catalytic capital. We're coming in often while the company's still private or shortly after they're listed. We're providing the money for them to go out and do what they said they're going to do. So whether that's run an exploration program, whether it's build a mine, whether it's improve an operation, what have you, doesn't really matter. we're providing that capital for them to go and do it. And you've probably figured out, Bill, and I'm sure many of your listeners as well, like mining is not a business that tends to move quickly. Projects take time to come to fruition, to create, to add value. And so we take those value, we take that time. And that's why if you look at our total portfolio from inception over the last 3 years, we're up something like 125% on the whole. So, we're consistently getting returns that would be outperforming many of the best hedge funds in the world. But we take a multi-year time frame for doing this.
So what did you learn most in the last year? As you self-critique yourself, what would you do differently?
Yeah. Again, I think what we did last year, we executed really, really effectively. I would say almost perfectly on what the Resource Insider mandate is, which is finding deals that investors can't find anywhere else. Our real strength, where we really consistently got the best returns, is in investing in private deals that are 6 to 12 months away from listing, providing that sort of seed catalytic capital that companies need to get over the hump into listing, into actually operating or executing on their program. And the reason for that is it's really hard to raise private capital. The junior mining market in particular is really designed around public markets. The most of the available money is available in public markets, but often companies still need money before they can list. So it allows us an unusual niche to go in and to get, I would say, frankly, really, really strong terms, because in a lot of times we're the only game in town, and we don't charge commissions. I don't take finder's fees. The company doesn't have to pay me to go raise money for them. We're looking for genuine, great investments to put our own money into. So I never take any fees from the company. So we're able to go out and cut these good deals. So we did that in 2021, and we're, I think, going to be really reaping the rewards of that in 2022. Looking back, where did we make a mistake? I would say there is one period where we overplayed our hand in Resource Insider, and that was in the gold run of the summer of 2020, right? And this was when gold was kind of ripping up from 1,400 all the way to 1,900 and then above 2,000. We did a series of deals in that summer, kind of in rapid succession. And now, again, we're very conservative. I'm very conservative in how we allocate capital. I do often, especially if I'm going to do a series of gold exploration deals, I do small bets on each of them, and I kind of consider that as a portfolio. But what we saw in that period is that small portfolio, or rather that quite large portfolio of small gold exploration companies. And we were getting in with full warrants. We were getting in often at 50% discount to what the company was trading at. Many, many, many of them are underwater right now. They've been hit harder than anything else in our portfolio at any given time. And so my one takeaway from that, and I knew this going into it, but it's, you kind of, you get stars in your eyes in the middle of a gold bull market, but you can't chase a commodity. You need to position yourself in a commodity before that commodity takes off. We were early in gold, and we made a lot of returns in gold from the deals we did, and silver for that matter, from the deals we did in 2018, 2019. We were early in copper. We made a lot of money in the copper deals we did in 2019 and 2020 and 21 for that matter. We were early in lithium. We were very, very early in uranium. We're seeing, I think, almost 300% returns on average in our uranium portfolio. But we had these 1-2 month period where we did a couple of these little gold deals. And that's where we see, if I look at our portfolio, where I see the losers, it's almost entirely in that period.
Jamie, I remember you coming on this show and saying it about that time that you were looking for deals, but you're only going to do deals at a discount. So what you're saying is even when you did it at a discount, a steep discount, just because of the pullback in the junior equities, you're still a little under the water.
So we did one. A great example is Norsemont Mining. Really, really fantastic asset in Chile, huge deposit, past producing mine, very cheap valuation at the time, particularly cheap for us because there was a warrant and we were literally investing at 50% of the price. So the stock was trading at, I believe at the time was $2 and we invested at $1. That got cut in half from $1 that got cut in half down to, I think it was about 60 cents at its low. We've since kind of come back and it's around breaking even, right around $1 again now. But it took a year and a half for it to do that, right? And that just goes to show you when the bottom falls out of these commodity markets, everything gets hit hard. Even things with good teams, even things with good assets, even things you thought you were getting in at a really, really good price. Never underestimate the ability of a junior mining stock to go lower than you think it can go.
That's right. Okay, so you positioned your subscribers in lithium, copper. Did you get any part of the uranium run-up we had this last year?
Oh, yeah. So we absolutely crushed the uranium run-up. So we did a series of uranium investments in 2018. We built a portfolio of I think it was about 15 names. I have to double check that. But when I look across that portfolio, we're up about 300%. And we've starting to slowly exit part of the position. I do think, we've got a ways to go in uranium yet. But I also think when you're up 300%, it's time to take a little bit of money off the table. Certainly take your cost base out, and then it's sort of all upside from there.
Okay, so we've been talking about the past. We're to learn from the past to apply to the future. You said we need to get positioned before those initial run-ups. Where are you positioning your subscribers?
I can see you lining me up to talk about what I'm doing right now, which is in the carbon credit sector. So this might sort of sound like a departure for someone who is a mining engineer and has spent, their entire career either working on mine sites or, investing in and helping run and build mining companies. But I started getting interested in the carbon market in 2019. And it was slightly before that time. I'm going to take a step back. I was sitting in Singapore with my partner at who runs Capitalist Exploits. His name is Chris McIntosh. We were talking about where do we want to be focusing our money over the coming, call it 5-year period. And this was in late 2018, or no, it was in early 2019 to be specific. And we kind of figured where I see a flood of capital coming is in the net zero investment, right? This is the move from every major government, every major institution, all the big capital allocators, all the big hedge funds to move to a net zero future, right? And this is, it's not zero carbon emissions, but it's net zero carbon emissions, which means the amount of carbon that is produced every year is the same as the amount of carbon that is consumed every year by trees and other sort of sequestration sources. So that was the driving force for us to start investing in copper, in lithium, in nickel, in cobalt, in things like this that we've been looking for and talking to and investing our own money in for the last several years now. And in that process, we came across carbon credits, and carbon offset credits, voluntary carbon offset credits, are basically credits that are generated by an asset. And that asset can be many different things. The most common and the most well-known are forestry and nature-based projects. So these are essentially the conservation of trees and forests, or the creation of trees and forests, planting new trees. And through quite a rigorous certification process, these things can be certified to generate carbon offset credits that can then be sold to anyone that's creating carbon, right? So this can be the Amazons or the Microsofts or the Exxons or whomever, any sort of company or individual that wants to offset their carbon emission. And what struck me about it was that the price was escalating very, very quickly. So, 2 or 3 years ago, carbon offset credits were trading at under $1 per credit. When we really started diving into this in earnest at the beginning of 2021, they were trading at about $5 per credit on average. Today, that number is closer to $10 per credit on average. And you're seeing this very, very rapid price escalation. And then what we have are the major institutions, the institutional analysts, and even sort of the private firms that have spent decades in this space. They're predicting that the price of this commodity is going to be going to $40 a credit or more. And the reason for that is there's a huge, huge supply crunch, right? So right now, the entire carbon offset market is somewhere between, depending on who you ask, because it's quite opaque, $100 million to $300 million per year. So that means every carbon credit that's sold, maybe it equates to $300 million a year. When you do the math, when you hear about all of these carbon emitters that are committing to a net zero future, so when you hear Microsoft or Amazon say we're going to be net zero by 2030 or whatever the date that they give, the way they're going to have to do that is purchasing offset credits, because, even if every company in the world switches to windmills and solar panels and never burns an ounce of gasoline again, there's still a huge number of processes, chemical processes, and just facts of daily life that produce these things. So when you hear these companies say we're going to hit net zero, it means they have to buy offset credits. And right now, there are commitments for millions and millions and millions and millions of these things right now. So, conservatively, people are estimating that this market is going to be $100 billion to $150 billion market.
This is the voluntary market we're talking about, right?
This is just the voluntary offset market. This does not even include what's going on in the compliance markets in Europe or California or Quebec or any of these places. So you've got this perfect storm situation, right? You've got a true sort of supply crunch, a massive amount of demand. And unlike basically any other commodity that I can think of, you've got the most powerful players in the world that have basically colluded to drive the price of these things up, right? You've got every government, you've got every sort of major capital allocator from the BlackRocks on down saying, you have to buy these things. We're not going to invest in you if you're a dirty polluter anymore. We're not going to be buying your iPhones or using it's everyone saying they have to do it. So it's becoming a cost of business for companies. So when we kind of saw this situation, we looked for the best way to play it. And, I think we've actually found it now. And this is the deal that I'm working on right now. And I'm investing. Frankly, this is the biggest personal investment that I've ever made into a company.
Okay, so when you take on a new venture, you do a SWOT analysis: strengths, weaknesses, opportunities, threats. What are some of the weaknesses or threats to this investment thesis?
The weaknesses or threats to this investment thesis. Yeah, I've given you a good idea of the strengths. So what are the weaknesses? I would say the number one weakness, and I don't think that this is a real one, but it's that the world sort of shifts gears, right? That they've decided that the math on going green, going carbon neutral doesn't add up, and that they're not going to do it anymore. They're going to continue to reinvest into oil and coal and gas and what have you, and they're not going to make these companies have these commitments. Now, that may happen at some point, but I don't think it's likely. I certainly don't think it's likely over the next 5 to 10 years. And it's because, Bill, I'd ask you this, have you ever seen such a consensus amongst governments, corporations, media outlets, investors, the big investors, that they need to go net zero? I've never seen a trend with such momentum behind it. It's and I look at it, it's like a giant, steamship. And it's you're not going to turn this thing around or stop it anytime soon. This has been a big global consensus. Big hedge funds and mutual funds and private equity firms are prioritizing net zero investments over profit. These are people whose little sole job is to make their LPs profit, and they are prioritizing net zero over that. So think about where the consensus has gone. And I would say to yourself or people listening, as investors, you shouldn't be thinking, well, I don't believe in global warming, or I do believe in global warming. That's not the right question to be asking here. What you should be asking yourself as an investor is, do I believe that this is happening? That all of this money is being poured into solving this problem, the carbon problem? And if the answer is yes, then you should be considering how you're going to position yourself to play it.
So this is your biggest way to play 2022, is that right?
Yeah. So we're calling this Project Carbon. We just launched it today. If you're not on our newsletter, you can send me an email. It's just jamie@resourceinsider.com, or you can go to resourceinsider.com and plug your email address in there, and you'll get all the information. But we've been involved in helping finance and launch a company that is solely designed to play the carbon offset market. it's going to be a royalty and streaming company. And for those in the precious metal space, you guys are probably, or who are investing in the precious metal space, you're probably very, very familiar with the Wheaton Preciouses of the world and the Franco-Nevadas and the Sandstorm Golds. These mining royalty companies that have a very simple model where they give an upfront payment for a portion of future revenue, or in the case of a streaming company, a portion of actual gold produced. And this company is going to be very, very similar to that, except it is pre-purchasing carbon offset credits for an upfront revenue, or for an upfront payment rather, from the developers that are actually producing these things.
That you then resell, Jamie?
That the company would then resell. That's right. So that depends.
Are you a wholesaler essentially? Would that be another term you could apply to this model?
I wouldn't call it a wholesaler, no, because the real beauty of a streaming and royalty company is that streaming and royalty companies are one of the most loved type of companies by capital markets, right? So when you look at a Franco-Nevada or a Wheaton Precious, they're often trading at what's called 2 or 3 times NAV. So NAV is net asset value. It's the value, the actual value of those streams, right? If a stream is worth $1 million, you put it into a public company, if it's trading at 2 times NAV, well, it's going to be trading at $2 million. So that allows these companies to trade at real premium. It adds a lot of value for shareholders. And you don't see that in mining companies, for example. Mining companies are often trading at 0.7 or 0.75 times NAV, because people know in a mining company, there's huge amounts of risk. Things get delayed, resources are wrong, people screw up, governments take the mine, whatever. And the shareholders are left putting the bill and paying for cost overruns and all the things you might expect. Royalty companies don't really have that same issue. They have no operating obligations. So yeah, the mine can shut down, but it doesn't cost them anything to maintain it, to keep it on care and maintenance, to do all the sort of things a mine would have to do. So the market loves royalty and streaming companies, and they trade at really premium valuations to pretty much anything else.
Okay, so a low overhead business model here we're talking about.
Low overhead. So I would say a truly asymmetric business. You have real upside, right? You're getting the cash flow from the royalty stream. You're getting the price exposure to whatever that commodity is. In this case, it's carbon offset credits. In other cases, it might be oil, it might be gold, what have you. And you're getting that financial multiple. So you have real asymmetric return potentials, and your downside is massively capped. So they're really, really robust businesses.
Okay, last question. Resource Insider was started to give people access to deals. So this is all about access to deals in this burgeoning carbon market. What makes you the go-to company for access to deals here?
So what makes us the go-to company for access to deals? Well, first of all, it's our full-time job. It's entirely what we do. There are certainly other newsletters out there, but to my knowledge, there are none like us. So we sell our newsletter purely to accredited investors. And, it depends on where you are, what that means. In the US, it typically means you make over $200,000 a year, or you're worth $1 million, excluding the home you live in. So those are rules set by the government. But if you meet those rules, then you can do something called private placement investments. And that's investing into private companies, or it's doing private placements on publicly listed companies. These are called PIPE deals. So this has been our focus for the last 3 years, 3.5 now, actually. And we've done over 30 deals in that time. We've had over 125% return if you've done every deal in that time. And so we have a track record of finding great deals for the members, for our subscribers, and we invest our own money in every one. Why specifically in the carbon space? The carbon space is really a burgeoning space, and a lot of it is getting birthed now. These sort of public vehicles getting exposure to that out of Canada, out of Toronto and Vancouver. I'm situated right in Vancouver. I've looked at probably almost a dozen of these deals over the last year. There are lots of people looking to get into this space. The one that we have found is by far the best that I've seen. It's got one of the strongest team. It's got a strong portfolio of assets. They've partnered with people in the carbon space. They're working with them that have decades of experience there. It's not some fly-by-night sort of mining promoter just trying to flip into a carbon deal and raise a bunch of money and get on with their life. This is a real company. So I think I've answered your question.
I think you have. Well, Jamie, thank you for stopping by and letting us know how you performed last year and what you're up to now. Again, if you want more information, go to Jamie's website, resourceinsider.com. A link will also be in the show notes. And Jamie, we'll have you on later this year to keep track of your progress.
All right. Thanks a lot, Bill.